Hello and welcome. I'm Alex Proimos, Head of Institutional Content and Investment Magazine, and this is Market Narratives. This show is a series of unorthodox conversations with thought leaders influencing the world of fiduciary investors. For more related insights and analysis, please remember to check out our website, investmentmagazine.com.au, and subscribe for a free email. And with that, please enjoy this week's episode. My guest today is Brian Singer, Head of Dynamic Allocation Strategies at William Blair. Welcome, Brian.
Hi, Alex. How you doing?
Very well. I thought today we'd start the conversation with the backdrop of where we are in markets today. How do we get to a situation where markets are so fragile that we need to continually provide stimulus to keep things going?
Yes, I don't believe that, anybody planned on being here. And I don't think policymakers, in particular central banks, actually ever thought they would be in the position they're in or ever even dreamed of putting themselves in this position, which is largely what's happened. They put themselves in this position, but they've done it over a period of decades, and they've done it increment at a time, little salami slice at a time, till suddenly it was all gone. And they acted in markets to try to socialize risk and personalize or privatize gain. And in doing so, investors have come to understand that that's a backstop for them. That leads them to allocate resources in a poor manner. If they allocate resources in a way that they wouldn't otherwise allocate resources. And now we end up in a situation where there's a lot of investment that's occurred that really wouldn't have occurred absent that behavior from policymakers. And now so much time has passed that the policymakers need to throw more at it. Every time that the market goes down, they try to support asset prices. And that's the nature of fragility. You ultimately reach a point where the market is kind of at this critical state. And when that happens, you'll start to see events. Many of them will be very small, but some of them will be very large. And there'll be a few that are just really extreme. And whatever the catalyst is, doesn't matter. It can be any number of things, but it's the environment that exists at any point in time that allow those catalysts to make the situation really compound and make it worse than it would otherwise be. And I think that's where we are today. It's in a sense a grave that we dug for ourselves, or policymakers dug for themselves, and unfortunately, we're the ones who have to live in the cemetery with them.
Look, it feels like some sort of a type of confidence game. Everyone's just got to sort of believe, and they look at each other, their eyes sort of swinging around the room, making sure, okay, are you okay with this? Are you okay with this? Is that an appropriate way to describe where we're at?
Yeah, it's interesting in terms of a confidence game. I'd have to think about that a little bit. It definitely is a trust game, which is, we might take it to a confidence game. And it, as a trust game, we've got an environment where investors trust that central banks have their back. And now fiscal policy too has their back. And they act kind of with that trust embedded in their decision making. And now it's the case that central banks have to maintain that trust. And it makes it more costly for them not to. And it requires, almost compels them to be involved in markets. And in the beginning, it wasn't as obvious, but now they call it a portfolio balance effect. And it's quite clear that they are boosting asset prices, or have been boosting risky asset prices, to change behavior in the economy and try to keep things going. And once you started down that path, you've gone from an environment where inflation or employment, whatever central bank you're looking at, is the driving force, and suddenly asset prices become a major driving force in their policy-making decisions. And in that sense now, it is a bit of a cat and mouse game going on between markets and central banks and public policymakers on a broader level. You can't afford not to be involved in markets, even though they're not reflecting the type of fundamentals that investors are accustomed to and should only be accustomed to working with. Now you've got this separate force that I would say is non-market, or it's shoving itself into a market such that it doesn't work the way it normally does. And when it doesn't work the way it normally does, you have to, as an investor, begin to guess kind of how will it work now that these policymakers are playing big and heavy in the capital markets that we deal with. That is maybe a confidence game in the end. It's definitely a cat and mouse game, and it'll keep going till I believe investors begin to lose trust that they actually have the ability, that public policymakers actually have the ability to be the backstop that they've convinced us over time that they are. And sooner or later, that'll go away. We don't really know of many instances where this has turned out well with central banks and public policymakers so influential in resource allocation and in capital markets.
So how did we get to a situation where asset prices seem to be the economy? It seems to be what we're managing. I wonder, with a situation where the average person around the world doesn't hold shares or doesn't hold them directly, but it seems that we're managing to an asset price level. That's where the focus of central banks has become. Yeah,
central banks have a lot of objectives that they ultimately have to work with. Yes, they do focus on inflation in a monetary regime. That tends to be, from the early 90s, that's really what became the overarching driving force for a lot of central banks. And as time has passed, that activity has kind of shifted out of their control. And one of the things that is, I think, difficult is a lot of them are kind of structured around a monetarist theory of inflation. Inflation is anywhere and everywhere a monetary phenomenon. And in reality, that may be true. But the question is, who creates the money? Central banks can create reserves and currency and circulation, but in the end, the actual money supply is a function of banks, private banks' willingness to provide credit. And if they don't, then we've got central banks losing control of that mechanism. And that's the environment that we're kind of seeing these central banks, I guess, try to figure out in some sense, because the response function of the markets is different from what it used to be. And in that response function, fundamentals are still out there and they're still important, but they're just held at bay, or their influence is there, but it's so hard to see the signal of fundamental values influence among the noise of the market's attempt to understand what's happening in central banks around the world and in treasuries around the world. Let's face it, if you look at the dot plots in the US with the Federal Reserve, they can't even figure out where rates are going. If they can't figure out where rates are going, and they're the ones who are trying to push them there, it's pretty hard for the rest of us to be right on top of these things and figure it out before they do. So it's really an unstable environment that we have here. And I don't think it's going to go away. We've got a long period of low volatility. And I think a lot of people might, a few years from now, be looking back at that very fondly and wishing we were still there.
Let's go back to one of the issues around fundamentals, right? When we go to university and when we do the CFA program, there's this whole premise around rational, analysis, rational behavior of people, efficient markets. That's what we're taught as this great way that systems clear and so forth. But it feels like we've got to this situation where we've totally removed ourselves from fundamental value, and we've gone to instinctive behavior where prices don't seem to matter. valuations, are sort of on the second ground. People don't even really care, and there's this price insensitive buying. Is that to do with the central bank, their constant influence, or is there other market narratives that are being put out there that are driving this, this wave of excitement, exuberance around parts of the market? How do we get to a point where we thought markets, played a very important role in capital allocation, to the point where who cares? You just got to be in it to win it.
Right. That's an interesting kind of perspective to take on things. And yes, the CFA Institute, in providing or allowing individuals to earn their charters, teaches a good bit about fundamental analysis. And that's really pretty much the cornerstone of what the CFA would learn. In studying for the exams, that's what you would learn. And you also learn that investors are roughly rational, and they do respond to information in the strong form, weak form, FAMA type of but people don't typically engage in the market with an attempt to be irrational. And they've learned the fundamentals, and the fundamentals aren't working. It is rational in that environment to move to something else that actually does work. And in particular, in moving to something else, what often becomes the case, and you use the word instinctive, people often then react to things in a more instinctive way than in a thoughtful way. But I wouldn't call that not rational. It's rational in the skewed incentive structure that has been created for them to survive in. And are markets efficient? No, they're not efficient now, because they're not really free markets anymore. They're markets that are heavily influenced by fiscal policies and monetary policies in countries all around the world. They're the 800-pound gorillas, these policymakers, and they're having a huge impact on pricing. And it's fine to say, I'm a fundamental investor, and I am a fundamental investor. And it's fine to say that I think value is above or below where price is. And sooner or later, let's face it, when investors make decisions, the only good decisions are those that are actually worth being made, where somebody is paying what something is worth. Something is paying its value ultimately. And price might deviate that for a period of time, but now these decisions are not being made as much on fundamental value. So that all of what we've learned is still there. But there's a layer that we have to kind of machete our way through, to blaze a trail, to try to find out where those fundamental values are amidst the behavior of these policymakers. And in some sense, we all sit around, and it's kind of like the Keynesian beauty contest. We're trying to figure out what the other person is thinking rather than thinking what we're thinking. Because the other person's instinctive move, once it becomes a herd, is really also a powerful force, and often done in response to what central banks do, or what fiscal policy drivers actually have in terms of their influence on the market. So I think the fundamentals are still out there. And ultimately, resources are allocated in a rational way such that the economy grows over time on a global basis. It's been right around 3.5% real growth over the past many, many decades. Maybe it'll be lower than that because of demographics as we go forward, but they're still making these decisions. They've always made these decisions. They've always allocated resources, sometimes right, sometimes wrong. But now they have to, in some sense, actually allocate or misallocate in the short and intermediate term, in some sense trying to make sure that they can survive and prosper until they can actually act in a way that is probably much better for society than what they're forced to do now. You
raise an interesting point there at the end around prospering in this environment, Because I think one of the biggest challenges that investors have is, they're usually peer aware. They've got benchmarks they've got to beat, and so they may have this this series of wisdom that they've built up over years, from their teachings at university or the CFA Institute, but their wisdom or their set of knowledge is being changed. The thinking that they've been told this is how you need to invest and how to sort of stay the course and come back to fundamental valuations. That's sort of getting pulled. It's getting picked at. Because they're investing, they're finding that their performance is doing poorly. Particularly a lot of these value style investment strategies. So they see that and they keep saying, "Well, I keep losing in this, and maybe I need to change my thinking." How do we then tell people either to stay the course or maybe that there's been this paradigm shift in markets and your thinking now needs to evolve?
You used an interesting term there as you were asking, and that term was wisdom. And I wish I could recall who it was that gave this to me, or I heard it, but it was referred to as a wisdom hierarchy. And that wisdom hierarchy involves data first, information second, knowledge third, and then ultimately wisdom. So what are all of those things? Data are just little anecdotes, ultimately. We can call them facts if we want. And then when we understand the ones that are important, because they help us in creating a model of the world, they help us understand things. And we look at it and we say, well, the price of beans in China is probably not that important for whether or not I build a house in this neighborhood or that neighborhood. But there are things that are important, and that's the information. And then ultimately, when you pull of all those things together and you bring them together based on their correlations, and in some instances, even lucky enough to be causations, that we'd call knowledge. And the knowledge is basically saying this model of the world helps me make good decisions. For example, a fundamental value-based model of the world helps me make good investment decisions. But there are other models that can be employed as well to make good investment decisions. And ultimately, wisdom in this hierarchy is the experience that allows investors to choose which models are appropriate at any point in time. And I really like that. I thought that was a good way to think about what we do and what people's roles are in what we do. And the difficulty is as we get older, we have in some sense less knowledge. Our knowledge is getting older, more stale, but we have more wisdom because we've had experience applying different models. And because of that, we're able to apply these different models. And often I find that there's this interesting commingling that needs to occur between the young and the old in our industry. I want the young to come in with knowledge, fresh knowledge, without responsibilities, and they can innovate, they can take risks, they think differently, and because of that, they see things in ways that people who've been around the industry forever can't see. Then the older ones have this wisdom to take what the younger ones do, have this knowledge, and actually take their models and take their understanding and apply it to the markets. What's different now is nobody really has any experience in this. I mean, our experience ultimately is being slowly gathered over the years, but it just seems to be becoming more and more extreme. And because it's becoming more and more extreme, the models become a little different each time. And there's this need to integrate the thought processes of the young and the old, but many young have never seen anything bad. This is the first thing they've ever seen. They haven't gone through October of '87. They have not gone through the oil price shocks. They didn't go through the tech bubble and bursting. And a lot of them didn't even go through the financial crisis. So they don't know that there's a whole set of models that help them survive as opposed to just thrive. And it's easy to think about thriving when someone's socializing the risk that you take. but there'll come a point in time where wisdom will actually be incredibly valuable, because there will be a need to draw upon those models that allow investors to survive. And those we really haven't seen applied until very recently, when society was disrupted by this virus. But that's really the first for a lot of people. And it's an interesting balance as to how you combine those two things. And often you find, and this is what we find in the marketplace, a lot of times models are not deductive in nature. They're inductive in nature. They're milked from the data. They're empirical, and that's fine. So you can be very successful doing that. But you can also find things that are ephemeral in the sense that they're only valuable to the degree that policymakers are engaged in the way that they are engaged now, or were engaged before, or are likely to be engaged in the future. And those will work, but then there's the point where somebody with wisdom has to sit back and say, well, maybe that's not the right model to apply now. Maybe now the environment is changing such that we need to be thinking about models that focus on survival in our resource allocation. And it's an interesting balance, and there's no right or wrong answer to it. It's really just, how do you pull all of this together in the decision-making process, in the team that you have, and how do you leverage all the different perspectives of both knowledge and wisdom to be successful?
It's interesting, you ended off with the word being successful. I guess, the way success is often measured in financial terms, and for a lot of investors is around, performance. It's a percentage number, as in terms of how much can you grow as opposed to capital preservation. It seems that we've had that disconnect. And so I wanted to ask you that question with a situation where we do seem to have an altered risk environment. There's this premise that volatility is actually quite low. And so returns are also stretched. So you need to sort of take additional risk to get higher returns. But there's seems to be thinking about that left tail. What happens when things go bad? So how do you have this situation where performance is, on one hand, the only piece, and that's all people sort of bias their mindset, so they blinker themselves to that part, but then they're totally cutting off that left tail?
Yes, sometimes being successful is surviving, but not often. Often being successful does mean winning the game, playing offense rather than playing defense. And people lose fear when volatility is low. People lose fear when they think somebody's protecting risk for them. And they can focus on the return aspect of performance, which is the one that people respond to in the short run. And the key to this is, how do you figure out the appropriate time horizon to think about investment decisions? Unfortunately, our industry, for various agency reasons and otherwise, is really focused on an inordinately short period of time, and an unrealistically short period of time in terms of actually managing both the success of good performance and the success of navigating big fat left tails. And those ultimately both have to occur. You can invest in a risk of ruin strategy and win month after month after month, but it doesn't matter which month you get down 100%, it's all gone. You can have made 10 billion% before you lose 100%. But once you lose 100%, it's all gone. And that leads to interesting behaviors. A lot of times, and people don't even realize it, that this is often happening, they'll invest a portfolio and they'll create concave structures. What does that mean? Think of credit as a concave structure. It pays off most of the time, but occasionally there's a default. That's kind of a risk of ruin type of strategy. That's that tail that's hanging out there. And investors gravitate to more and more exposures like that. And they can come from many different sources. They can come from investing in illiquid assets. Momentum is value is more of value is more of a concave strategy. These are the things that tend to pay off in little bits and pieces over time, but they have tails associated with them. And that performance is rewarded because horizons are short. And when horizons are short, it incentivizes investors to think about picking up nickels and not paying attention to the steamroller. However, these things are like a pendulum. They swing back and forth. And investors do this in periods of calm, and then the steamroller rolls over them in periods of crisis, and behaviors change. What we've observed over the past 4 decades are these are basically waves of monetary policy, big waves, not week to week rate changes and things like that, but big waves of monetary policy that last years. And when there's stimulative monetary policy, you tend to find a couple things. One is risky asset returns are relatively high. And that makes sense. As I mentioned, they call it a portfolio balance effect now. They also tend to dampen volatility. And that also makes sense because they're actively engaged in markets. And being actively engaged in markets and influencing prices, they do have the effect of dampening that volatility, or as we've observed almost explicitly, socializing downside risk and taking that away from investors in the marketplace at any point in time. And it's that, I think, process ultimately that is occurring that leads to these periods that are rough patches. And that's when the the stimulative monetary policies stop. Kind of like snow on a mountain. The snow keeps falling. It's very calm. It's very serene. And it becomes this kind of soft, curvy surfaces. And after a while, there are little bunny prints and things like that. Everything's just perfect up until the avalanche occurs. And that's much the way markets work. And not always, but they get themselves in these environments where they're susceptible to an avalanche. And let's face it, if there's no snow on the mountain, there's not going to be an avalanche. But once there's a lot of snow on the mountain, there could be. What's going to cause it? The next snowflake? A little earthquake? Who knows? But you end up in an environment where that can happen. And that's what we've observed over the decades. And that means ultimately, as you and I have been talking, that central banks have a greater and greater onus once they put that snow up on the top of the mountain to keep it there. It's kind of like their behaviors, if you think about a lot of times in the winter, it snows in the hills and every mountains, and you put up these little fences to hold the snow back. And that's kind of what central banks seem to be doing. They're like holding the snow back, and it piles up more and more behind those little fences. And in the end, all that happens is the avalanche is bigger when it ultimately occurs. Now, they're able to dodge a lot of avalanches, but in dodging them, they make it bigger. So what have we had since the Greenspan put? Dodging. We've been dodging the risk. We've been putting up fences. Public policy has been all about putting up fences, regulations to make things not happen anymore, central bank policies to make risks not happen anymore. And these fences keep coming up, and it simply exposes the market to greater fragility and ultimately turbulent times. And that's where I think we're moving now. And I think we're pretty close to that. We're already in it. We're seeing the initial cracks of it. We saw that. The repo market issues have kind of clearly been indicating it. But, this virus, COVID-19, is mostly just revealed it, or mostly just been a spark behind the market moves that we've had. And it's been that way. It's been built to be this way for a long period of time.
Let's take it more back to the portfolio setting, right? For an investor, as they think about their portfolio, we've all heard about the 60-40 portfolio. We've heard of SAA, that the funds need to build. Are these types of strategies in terms of setting up a portfolio that was historically done still relevant given the backdrop where we seem to have, a centrally planned world? We've got this constant backstop. Do those structures still make sense? In SAA, when we talk about SAAs as this long-term approach to building asset allocation, from what you're discussing, that there's all these constant flare-ups. How do you make sure that correlates with what we're actually seeing in markets today?
I think the strategic asset allocation, or the SAA, is very, very important, and it can be put in place. The difficulty is that nobody acts as if that's really what is important. There's a lot of knee-jerk, short-term decision-making that occurs that kind of prevents that from happening. However, the decisions that need to be made are the decisions that have always needed to be made, and they will continue to need to be made. And now, in terms of a portfolio, how do we navigate the path to get to that SAA outcome that we want? Back in the last century, after modern portfolio theory came on board, let's face it, modern portfolio theory was a single period framework. And there wasn't a lot of thought given to path dependencies. And now what we're learning is that people, maybe sparked by the global financial crisis and now by this, people are concerned about path. Path matters. And the SAA is still important, but I believe that in setting up a policy for a portfolio, these days you have to actually consider path as well. The ability to realize that long-term outcome has become more difficult because there's a desire to navigate path. But there's not a lot of direction that investors set for themselves about navigating path. So we can all sit back and say there's a problem with short-termism, and we want investors to think long-term and allocate resources long-term. And we've known that for decades, and we haven't gotten anywhere with that. And I suspect that we can continue to beat that drum, but 50 years from now, we'll find exactly the same thing that we find right now. And an alternative approach to that is not to just say, well, people need to invest for the long term. Well, they do. But the reality is they invest for the long term with a management of the path that gets them there. And these policy statements should probably include, before the fact, language about acceptable and unacceptable paths, not just the SAA as a static concept over a period of time. So I think it's still important. I think it needs to be augmented by this path type of consideration.
So going back to the 60-40 portfolio that we've always seemed to use as that sort of standard, how do you think about that's role historically is there? Is that dead in terms of that balanced portfolio when we think about the return and risk characteristics that would make up that portfolio in the current environment?
No, I think it's still important. Whether it's 60-40 or 40-60, I think there is an objective out there in terms of return and risk that's appropriate for the long term. And I think there's an appropriate combination of assets, liquid and illiquid, that investors use to realize that return and risk around the 60-40 that they actually desire. In the interim, in terms of making investment decisions, now the investment decisions involve a lot of different things. So, for example, we can look at fixed income and say, well, fixed income is not a good return generator with yields around zero. That's not going to be great for savers or investors. At the same time, it's probably not appropriate to be zero in terms of allocation to those, because pathwise, it may be the case that they don't go up for a long period of time, or maybe yields even go lower from 60 basis points in the US on the 10-year down to 10 basis points. Or in Italy, where we're up 1.5%, 2%, which is astoundingly low, down even lower. The spread to German bonds goes even lower. And the decisions that are made in a portfolio context on a day-to-day basis, yeah, they have that in mind. But in an environment where there's been such misallocation of resources, it needs to be allocated in a way that can navigate that misallocation as it unwinds, navigate central bank activities as they unwind. And we know that'll probably push yields higher as inflation comes in. But at the same time, between now and then, as efforts are still strong to try to keep interest rates lower, it may not be the best idea to be short. So if you think about a portfolio today, you might have 60-40 as your starting point, but you may want to be further from that 40% bonds than you've been for a long period of time. Or you may look at it and say, yeah, I'd like to be for my long-term strategic allocation, but for now, it's too early to do that. Even though they're very, very expensive, I'm still going to hold them closer to 40% until I actually feel that the path is in front of me that I want to travel. So a lot of decisions that are made today are made with that in mind. For example, I don't invest in gold as an investor for my clients. I am a fundamental investor. I discount future cash flows to come up with value. And I can't determine what value is in that manner for gold. Now, that doesn't mean that gold prices don't go up and down and create opportunities for investors. They do. They go up and down and create opportunities for investors. But gold also provides an interesting risk management augmentation to a portfolio as well. And where in the past, it may not have been that big of a deal for a strategic allocation or something along those lines, these days, I think it has a more important role from a risk perspective, an inflation perspective, a disaster perspective. It's kind of that tail management vehicle in risk terms that's important. And earlier this year, for the first time in my life, I actually bought gold for myself. I'm not buying it for clients because it's not what I necessarily do. I can't value it. I'm a fundamental value investor. I don't want to be running around doing things that aren't fundamental value. But that's the type of thing in this environment that investors do need to be open to, and maybe even if it's not in their strategic asset allocation.
You raised some more interesting questions around what defensive assets look like. You sort of gold is seen as one. As you think about a portfolio, and a lot of investors talk about robustness of their portfolio and having these uncorrelated assets. But ultimately we keep seeing whenever there's a crisis, all these supposed and in some cases unlisted or illiquid assets that are seen to be these defensive plays aren't so uncorrelated in the marketplace. So how do we then rethink, or how should investors rethink what defensive assets should look like in this environment? Or does it need to be defensive strategies? Is that the way to think about it?
I think there might be some interesting ground broken here. The last half of the last century was pretty benign for all intents and purposes. The Cold War was geopolitically stable, and now we have instability. It was a period of demographic dividend. And now we don't really have that anymore. So it was a good environment and to think about something as a 60-40. But these days, I think investors need to be a little bit more open-minded in the things they think about. So let's say inflation as a concern. TIPS, or inflation-linked securities around the world, can provide a hedge against inflation. So can cash. Cash provides an interesting hedge against inflation. But another one that's also important is non-domestic based currencies. They provide an unbelievably good hedge of unexpected inflation. Because if you think about unexpected inflation, that tends to cause the currency to depreciate, and you're protected from that if you're not invested in your currency. So I mentioned cash as a part of a portfolio. it's rare. It's rare that strategic allocations will have a large chunk of cash as part of the portfolio. But it may not be a bad idea to do so and have the cash, but have it in other currencies. Now, if the entire domestic world is developed world is a threat from an inflation perspective, then the other currencies would be developing world currencies. And that's fine, but that's a little bit requires a different mindset than many investors are used to. So you can think of as a risk management capability, an allocation for a portfolio, an additional allocation for a portfolio that might be important to consider in these days would be holding more cash than is usually the case, allocating it in currencies where you don't believe there will be longer term unexpected inflation, and something like gold, which helps on tails and may even help on both tails, a largely deflationary environment that leads to such an extreme safe haven pursuit, or an inflationary environment that would as well lead to gold prices going up. What's interesting about this is you mentioned illiquid assets. Illiquid assets, people talk about the liquidity premium as if it's a free lunch. Well, it's not a free lunch. It's the compensation you get for giving up the opportunity, giving up the option of investing in other mispricings that occur, other opportunities at any point in time. And that's kind of the opposite of what owning cash and putting it in different currencies around the world is. So illiquid assets, in some sense, are not the type of thing that you want for an unstable world, for a world of high volatility and tail risks. But people were seduced into illiquid assets because they don't have that up and down on a day-to-day basis. Or as you said, they're not really correlated. Well, they are really correlated. And if you think about, a bat flying through a cave, you watch it go in one end of the cave and it comes cruising out the other end of the cave, and you say everything's just fine. If you had the ability to look inside the cave, this bat's flying around and slamming into stalagmites and all kinds of stuff, beating itself up, and finally comes out the other end and everything looks fine. But in the interim, just because you didn't see it doesn't mean it wasn't there. And just because you don't see quarter to quarter or month to month volatility in illiquid assets doesn't mean they're not risky. They are risky. And when equities go down like they go down, when liquid equities go down like they're going down now, guess what? Illiquid equities go down, private equity goes down at the same time. You might compute a low correlation, but that's really not reality. The reality is that these assets are claims on the underlying economic engine, and if thoughts about the economic engine improve, these assets will often have higher returns. If thoughts about the economic engine deteriorate, they'll often have lower returns, expected returns and returns together. But that's more of a longer term concept. In a short term investment environment, people get seduced by, if I can't see it, it doesn't happen. Well, it does when it does. And I think that's an interesting aspect about portfolios as we go forward. So many have invested in illiquid assets. There's been such a pull of asset allocation, of assets under management toward these illiquid assets. In reality, it perhaps should have been going the opposite direction.
So you mentioned the bats in the cave, and you have no idea what's going on. It feels like there's some sort of a matrix that we're living in. There's these things happening, but we don't understand what's actually really going on. But we're still allocating money to the area, right? We're still sort of putting money into that pool, and it's coming out the other side, and we're hoping that we're getting it back. If when we get back to where we started this conversation around sort of the money printing that's been going on. What is reality actually we're living in? We've got 25 trillion of debt in the US balance sheet. What is money? Money seems to be all sorts of figurative instruments that are out there. Like I don't know. I get very confused by it because we're sort of taught a particular way of living, but it feels like we are living in a matrix where you can have $3 trillion stimulus here, 25 trillion on a balance sheet here. How do you navigate this sort of environment?
I guess there are two ways there's one decision that ultimately needs to be made, and that's if you think about the matrix environment, do you take the red pill of accepting the unpleasant truth, or do you take the blue pill of blissful ignorance? And we have been taking the blue, not we, but in general, in our institutional industry, there's been a lot of consumption of the blue pill, the blissful ignorance of low volatility, meaning low risk, and not of the red pill, which is the unpleasant truth of things. And as I think about this environment, the concept of money is changing. And that's an unpleasant truth for investors. It's an unpleasant truth for central banks as well. And I alluded to this a little bit before in kind of this monetarist theory, which many people support, central banks support in terms of the influence of monetary policy on the economy. And we're learning, as I mentioned, that the central banks don't have as much control as they thought they had. They can control liquidity in the system. They can flood the system with reserves, and they can manage that liquidity. But they've reached a point now where the supply of money is so great that the demand curve is flat, and they can't use money supply as a interest rate mover. And they have to manage interest rates directly. So now money's become this kind of different concept. Money's something that banks create through a credit facility, and private investors through private credit create money ultimately in the system, and that's different. It's disintermediated the traditional financial intermediary role and moved the control of money away from central banks to some degree. And I believe that's where we are now. I think it's a regime shift. I think we're leaving the old regime of a monetary or inflation-based regime, inflation targeting-based regime, and we're shifting to another regime. And we hear about MMT, monetary theory, and that's important, but it's beginning to reveal the way people think about money right now, is that governments can spend, and all that we need to do is central banks just write a big check and write it to the Treasury, and everybody's fine, everybody's happy, and that works as long as interest rates are low. They're messing around. It's not really the type of money that people are working with every day. And I think that's a different mechanism, and that different mechanism means that the models that people have to think about in terms of money are changing. Maybe that'll make more room for digital currencies. Maybe it'll simply just get hard paper currencies, less in circulation. If you think about it today, I guess most people, if they're listening to this, think of the last time they used money, or think of how they used actual bills and coins compared to what they did before the virus hit and before these lockdowns were put in place. It's been a very significant shift, and it's been a significant shift in the way that the market's kind of gone anyway, and it's away from that kind of hard stuff that you carry around to more digital stuff that is a little bit further out of control of central banks, and I think that's an important aspect of decisions, and that's maybe one of the reasons when I think about an asset allocation today is maybe people need to be a little bit more open-minded, that there might be other things out there like cash and gold that behave differently in this environment, maybe have better characteristics in this environment than in the old world that we're all used to.
So let's leave it on a final question as we think about this situation that we're in. And if the last question seemed like I was confused, it was because I just don't know. It feels like we're all taking the blue pill. But what are the triggers, or what are some of the factors that you are keeping an eye on to sort of have a feeling that there is a regime shift again, that fundamentals come back, that what central banks have done previously is looking like it will fail? Is there any road signs that you're looking at?
Yeah, I think the important thing is to realize that we have seen this before, and maybe not in terms of degree, but we've seen it before. A gold standard helps prevent it, but often we find that gold standards are abandoned, as Nixon did here in the United States. And when Bretton Woods broke at the same, those types of things are things that kind of release central banks to do things that they haven't done in the past. But we've seen low interest rates like this persist for long periods of time, ultimately when debt levels get high. When debt levels get too high, one of the ways that governments, or even for the delevering of this society as a whole, creating inflation is one thing, but that's harder and harder to do for central banks. Another thing that can be done, if they're in the mode of controlling rates rather than controlling them through money supply, they can maintain low real risk-free rates of interest and low real rates of interest that help work off this debt. And when we have seen this in the past, it persists for quite some period of time. So I would say, we can learn from the past here. I would say this is definitely a case where there's loose rhyming, but not repeating. And we should, from that, anticipate low real rates for an extended period of time. And we'll see what happens with inflation. I suspect we'll see inflation coming back as well. But this is an environment where we're likely to be in for a good period of time. And as we're in this environment, we'll shift more and more to seeing inflation managed by fiscal policy, where taxes can go up or spending can go up. And if taxes go up, that'll put downward pressure on the economy and pull inflation down, or government spending can go up. That would push aggregate demand up and maybe boost inflation. I'm not necessarily saying I believe in all of this, but this is the concept, I think, the direction that we'll see policy move over time. And I think those are all the things that need to be taken into account for investors today, and not to lose sight of that as they're trying to navigate the path, the short-term waves. I like to describe it sometimes as asset allocation, or policy allocation, strategic asset allocation, is distinguishing between the tides, the waves, and the ripples. When you look at the ocean, what you want to do is ride the tide, navigate the waves, and ignore the ripples. And unfortunately, we're not really there right now. And I think that riding the tide means riding something that's a little different from what we've ridden in the past. And two, I think the waves are relative to the size of the tide. The waves are much bigger. And that means you got to pay attention to the waves. The navigating becomes more important. But still, avoiding the ripples. There are people out there, algorithms and things like that, high frequency traders. They can mess with the ripples. That's fine. But from a broader institutional or ultra high net worth perspective, when we're thinking about strategic asset allocations and things like that, it's a let's go Huxley, a brave new world.
All right, that's a fantastic place to leave it. Thank you very much for your time today, Brian.
Thanks, Alex. I appreciate it.
Thank you for joining us. All views expressed on this podcast are subject to change and do not necessarily reflect the views of Conexus Financial. This podcast is for educational purposes only and should not be relied upon as investment advice.